Good afternoon, traders and investors. Will back here with another one, coming to you with a Thursday market recap. Hope everybody had a very good day. And in today's markets, guys, well, we finally put together an extremely solid bounce from the start of the morning all the way through the close. A very stark contrast in terms of the last 3 days of trading, where we would rally in the mornings and then sell it all off in the afternoon. Now, obviously, guys, 1 day's worth of bounce isn't enough to say that the pain is over, but at least it's enough to say that the bulls at least have some life left in them still. Now, the reason for the bounce today, guys, is we got some jobless claims reports coming in this morning, which were better than the expectation. The consensus was for 240,000 jobless claims, and it only came in at 233, so lighter than the expectation. And this piece of data, guys, usually is just not even looked at by anybody. It comes in on a weekly basis every single week of the year, and usually people pay it no close attention unless it doubles or something crazy like that, right? But obviously, after last Friday's non-farm payrolls jobs report, all eyes were on the next piece of jobs data because jobs represent an integral piece of the puzzle for the Federal Reserve right now. We obviously know that they've hiked interest rates very, very high to try and cool down the economy, to try and subdue inflation. But there's a problem with that. When you do that, obviously, the economy starts slowing down. Everything starts contracting, consumers have less disposable income, and then potentially if companies get hit too hard as well, you may see some layoffs and unemployment go up. So the goal for the Federal Reserve was to time this as best as they could to not hold rates too long to crush the economy in the process, which is why everybody now extremely vehemently wants a September rate cut because we're starting to see some cracks in the jobs market specifically. So moving forward, guys, I don't really think that inflation data is going to be what's going to be driving these markets moving forward. It is largely going to be economic data in terms of output and jobs data in terms of how well is the consumer employed right now. That is going to be what everybody's going to be looking at least for the next 2 to 3 months. So obviously, guys, very, very difficult to predict on the channel whether or not a recession is going to come or not, whether it's going to be shallow or deep, but that's not the purpose of the channel. We're not meant to predict these things, right? We are just going to react to the data and trade and invest accordingly. So today's bounce was very decent. What I have prepared for you guys in today's video is a few key things. Number one, we're going to go over 2 company earnings that happened today. Those are going to be Elf Beauty reporting after the close and the Trade Desk as well. So we're going to tackle those first. Thereafter, we're going to take a look at our major market index rundown in terms of technical analysis to see whether or not these bounces are sufficient enough to warrant further continuation, or are they maybe just an opportunity to load up on more shorts? Thereafter, we're going to take a look at technical analysis on our big tech names and do the exact same thing, see if there's any merit to buying the dip at current levels. So without further ado, guys, a lot to cover in today's video. Let's jump right into it. SPY up a very healthy 2.31%. QQQ putting in a above 3% gain on the day, and the gains were really all across the board. Take a look at the heat map, guys. Been quite a few weeks that we've seen a beautiful heat map like this, nothing getting left behind, big tech performing very well, and semiconductors really leading to the upside, right? After leading to the downside for the past 2-3 weeks, nice to see them finally putting in a decent day of gains. Financials, healthcare, everything performing very well. Now, in terms of the one-day relative, you will see that really no sector was left behind, green across the board. However, the damage over the course of the week was definitely done. Every single major sector, guys, is still in the red even after such a tremendous bounce. And that is largely because we're still trying to get back from the Monday gap down, from the quote-unquote Black Monday that happened after those issues in Japan carried over into the US markets, of course, right? So unfortunately, on the 1 week relative, we are still negative. Now, before we get into more technical analysis, let us dive right into our earnings, and those are going to be very, very nice for today. We're going to be doing Elf Beauty, so let's jump right into it. So Elf Beauty currently right now in the after hours down about 10.5%, and that, as a matter of fact, was the expected move. Is it because they had a bad quarter or because they issued weak guidance in terms of maybe caution around consumer spending? No, not at all. They actually crushed everything. They not only beat on EPS and revenue, as you can see right here, nice little beat on EPS by 32%, definitely a wide margin beat, and a nice beat on revenue by about 6.5% as well. Guidance as well was very good, so triple beat across the board. So why did the stock drop here, guys? Well, we're going to jump into the article and go through their numbers and try to determine, even though this company posted amazing results and phenomenal guidance, why are they down right now 10.5%? You guys know consumer discretionary has been struggling as of late, so let's have a look at what Elf Beauty had to say. So moving on in, Elf Beauty sales jump 50% on gains in color cosmetics and skincare, launch of bronzing drop serum. So let's move into it, guys. The eyes, lip, face, and beauty giant's sales soared to 324.5 million in its first fiscal quarter, leading it to raise its full year guidance. That increase follows a staggering 76% jump in the year ago quarter. Amazing revenue gains from this company, guys. The CEO told CNBC the company saw growth across all of its categories. Very, very solid quarter report from them. Following quarter after quarter of outsized growth, Wall Street has come to expect a lot from Elf Beauty. Though it raised its guidance Thursday, the outlook still fell flat after such a big first quarter beat. So some of the reason for the drop here, guys, definitely has to be the comparables, right? Comparing prior to a year that was a very good year for Elf Beauty. It's going to get very tough for them to beat it. And if you want us to take a look, we're going to dive into this later. But here's what I mean. This is the phenomenal growth that you had in 2023 and 2024. Look at these numbers, right? It's even though they put in a 50% revenue bump, it is still not in the 70s or 80s. So you can argue that yes, growth is slowing compared to the prior periods, but growth is still excessively good, right? So that is possibly the reason why the stock is selling down in the after hours. It is decelerating from extremely high growth to still very good growth. Just goes to show you how very picky Wall Street is right now in terms of growth metrics leading into possible economic uncertainty. But is that economic uncertainty affecting Elf Beauty? Let's have a listen. Last year, here's what the CFO had to say. Last year, we started our guidance at 22 to 24% range and ended the year at 77%. I'm not saying that we're promising 77% for this year for sure, but what I will say is it gives you a little bit of insight into our guidance philosophy. If you look at our history over the last 5 years, these 22 quarters, we typically guide lower than where we eventually come out. This is the CEO. We never want to get ahead of ourselves, and overall, the strategy has worked just great. We're going to take you through what we're seeing quarter by quarter, and hopefully we continue the kind of beat that. Now, he added that he isn't concerned about a consumer pullback in the beauty category and remains bullish on the broader environment. So no consumer slowdown for them. Here's a line he's probably been preparing for a while. Listen to this one. We are hearing kind of in the macro, hey, is the consumer being choosier? And here's what he said. I'd say if they are, they're choosing Elf. Right? So classic line by the CEO. He's probably been prepping that one for a while, but still funny nonetheless. So we're perhaps differently positioned. And if you look over the last 22 quarters, it didn't matter what was happening in the category, whether it was the pandemic, whether it was inflationary pressures, you name it. We've performed well throughout that. And I think it really comes down to our fundamental business model and how we are different. Speaking about the business model, guys, right? They run an online business model. It doesn't require any overhead costs that other retailers do have, such as L'Oreal, such as Ulta Beauty, right? No physical locations for them. Yes, they do distribute their products in places like Walmart, Target, and Ulta Beauty for that matter in their stores, but they have no physical stores of their own, which allows them to keep costs very low. They are an entirely online brand using social media marketing to get their products out there and trend viral. So moving on down, it's known for creating value versions of prestige favorites, such as its new bronzing drops, which customers compare to Drunk Elephant's Sunshine Drops. The prestige skincare line offers its products for $38, while Elf's retail for just $12. This is what's known as their holy grail products. They try to imitate as best as they can leading products in their respective segments and then offer them for a fraction of the cost. And obviously in this environment right now where consumers are very concerned about budgeting, e.l.f. Beauty is the go-to brand for beauty products right now. This is why they are not seeing the type of slowdown that other brands are seeing. They are perfectly positioned for this type of environment. And although you can argue that beauty products are a consumer discretionary segment, but in all reality, there's also an argument to be made that they are maybe more of a consumer staple / defensive name. Because everybody knows, guys, right? People, recession, no recession, usually will not stop doing their makeup, right? They will still buy beauty products, but they may trade down from more expensive products to cheaper ones, and that is where e.l.f. Beauty comes in. So let's have a look. These bronzing drops were the #1 requested item from our community, and our community comes to us and says, hey, there's a prestige item there. We love them, but e.l.f. help us out. We can't afford $38 for bronzing drops, said the CEO. So what did they do? We'll study it. We'll put out our own e.l.f. twist on it, and we'll introduce ours at $12. Went to #1 right away on elfcosmetics.com. Just goes to show you guys, this strategy is perfect. Very, very disruptive strategy, of course. Now, even though we don't make the comparison ourselves, there's like 1,000 TikTok videos after we launched this product where people are doing side by side or comparing it. They're like, it's $12 versus the $38 item, and actually, I like the e.l.f. one better. The quality's better. Just goes to show you guys, their branding and marketing is entirely organic. They do not ask people to post videos about this on TikTok. People do it on their own. Extremely good branding strategy. So moving on. However, all of that marketing doesn't come cheap. Talking about the marketing that they do at the Olympics with other celebrities and stuff like that, because their marketing spend was a bit higher this quarter, which reduced their net margin. So here's what the CEO is explaining. All of the marketing doesn't come cheap and has weighed on e.l.f.'s bottom line. During the quarter, SG&A expenses increased roughly $88.6 million to $180 million, representing 56% of net sales. The spike in marketing spending contributed to a 10% drop in e.l.f.'s net income, probably also a slight reason for the share price decline in the after hours. However, he added, e.l.f. is working to get marketing spend more consistent throughout the year as a percentage of sales. We continue to invest more in marketing because it's working. Our marketing ROIs are multiples ahead of the category benchmarks. We're growing very strong top-line revenues. We are building awareness. And quite frankly, guys, it is definitely working. Now, let's take a look at some of their numbers, guys. Their numbers were definitely very, very good. And here is their guidance, right? So here is your prior guidance. I know it says 2025, but they just run one fiscal tax year ahead of the rest of the market, right? Still for 2024 numbers right here. So net sales, take a look at this. Prior outlook, they raised their guidance for net sales. EBITDA, they raised those as well. So more profitability, right? Tax rate is the same. Adjusted net income, yep, you guessed it, guys. Beat and raise on this as well. And EPS also having a consistent raise across the board for the next fiscal year. Extremely solid, guys. They literally raised everything across the board. So great positioning for them. Now let's dive into their net income figure. You can see their net income figure right now is sitting about 14.6%. Very decent here, guys. Here's e.l.f. Beauty profit margins for the quarters in which they've been a public company, right? And you can see gross margin always expanding. Operating margin also always expanding for the most part. You can see the trend, right? And trailing 12 months net margin has been peaking around 14-15%, but usually the norms are anywhere between, 10 to 12% for about the last 1 year. So to see e.l.f. Beauty come in with a decent quarter like this at around 14.6%, even with the increases in marketing spend, just goes to show you guys how fast they are growing, and still their net margins are well insulated, even if they do have a bit higher expenses over the course of this quarter. Moving on down for e.l.f. Beauty, just wanted to highlight, guys, in terms of the free cash flow, right? So you can see right here, net cash provided by operating activities, very decent. And they did they did spend less on property and equipment right there. So they did bring in a fairly cool $49 million in free cash flow, which is very good. It's a bit above the standard as they're used to on any given quarter. So very decent quarter for them. Nothing bad to say about the company, guys. Excuse me. If we go into their earnings slides, you'll see exactly why they're some of the best, guys. They're eating everybody else's market share for lunch. Look at the dollar share growth in relation to other cosmetics brands. e.l.f. really is being put on top. e.l.f. Cosmetics dollar share as well. They previously were number 5 in the game, now all the way up to number 2, 12.3%, guys. Extremely, extremely solid. Even at Target, they used to be number 1. Now they're number 1, but by an even wider margin. Extremely good numbers, guys. every single quarter. They keep eating away at market share from other companies, right? So very, very good segments from them. We're not going to go through all the slides, of course, but what I wanted to show you guys is their holy grail products. This bronzer is their new one, of course, $12 versus the $38, but they have other ones, right? Lip gloss, $8 lip gloss versus the $40 brand, extremely popular. This one as well, primer, $10 versus $38. This one right here, foundation, right? $14 versus $49. So it just goes to show you what type of business model they are trying to run. Unit volume growth for their skincare brands. Look, only one that is positive right now. Every single other brand is declining right now, which just goes to show, guys, they do have pricing power, right? People are flocking to them to replace other products as for e.l.f. Beauty products. Take a look at their snapshots between now and 2018. In 2018, they were approximately some of the top 2 performers in all of these categories. Now, several years later, they are now the top performer or the top 2 performer in 18 different segments, guys. They are really eating away at the competition fiercely, very, very, very fiercely. So I really like this company as a whole, no problems whatsoever. Now let's jump into some of their numbers and let's derive whether or not right now in the after hours at 168, is this company a decent buy? Well, take a look here, guys. Revenue is growing very healthily at 22%, but just keep in mind, guys, right? The revenue eventually will start tapering off a little bit. They cannot grow revenues on a year-over-year comparison by 50 to 70% forever. But for now, guys, they are still growing extremely healthy. Look at this EPS trajectory over the next 3 years. Very healthy growth, and revenue trajectory as well is poised to continuously expand, although not at the pace that we've seen in the last 2 years. Still very, very good expansion. On their balance sheet is also relatively very healthy, guys. Not really much debt to speak of as a whole. Take a look down here, right? So they do have about $290 million worth of debt, but in relation to the revenue that they bring in and their free cash flow, that is not that much. They actually have $108 million on the balance sheet, so fairly decent. And you can see every single quarter, for the most part, they do bring in anywhere between $30 to $40 million in free cash flow, which is why I say debt, not really a problem for them, guys, in that respect. So in terms of their numbers, EPS expansion also very healthy at 19% per year, double-digit growth for both of those segments. So in terms of the valuation here, guys, well, their forward price to earnings here at $170 is about a 49.7, a little bit elevated. And when we divide this by their EPS growth rate, it's about a 2.61. Now, this is a little bit high for e.l.f. Beauty. Even someone like me who loves the company can admit it. So this is another case, guys, when we are coming into potential economic uncertainty. Even though e.l.f. Beauty has not said it's being affecting them specifically, you have to understand that Wall Street is going to be very, very timid around the consumer discretionary segment, especially those of which have very high valuations right now, because any slight falter in growth will translate to a significant appreciation in the valuation, right? So need to keep that in mind. At 2.61, it is a little bit high in this current market environment, but I still like it, guys, especially if for some which reason we revisit this location right here. This is going to be an extreme nice area for some purchasing, in my opinion. It is pretty much your previous monthly support levels, prior monthly resistance levels, and that is really 150 all the way down to about 136. If we can find some further discounts in this location right here, I will be tempted to add to my position, guys. This is the only retail stock that I own in my long-term portfolio other than Louis Vuitton. They are the only two because of their business models, guys, right? So very nice stock. I am holding my shares for now, not adding more, but if we do dip down here, 150 to 135 should be a no-brainer add for me, in my humble opinion. I think this company is going to do fantastic things over the next 5 to even 10 years and really disrupt the way that the beauty segments operate in general, really disrupting the entire business model of in-person store shopping to really pivoting to online and viral marketing using social media, right? I love disruptive brands, and this is definitely one of those. But right now, it is not the cheapest stock out there, which is why I require a little bit more of a discount. Anything under 150, 135, I will be looking to add a little bit of shares. So that's pretty much everything for e.l.f. Beauty. Now let's jump right into our second earnings, which is going to be the trade desk. So the trade desk coming in after the bell right now with their earnings, and they are up a a very cool 6.26% right now. So what exactly happened, guys? Well, they had a triple beat on EPS by about 9.24%, beat on revenue by about 1.13%, and they increased their guidance for the remainder of the year. Very solid earnings report from them. Let's jump right into the article right now. So the trade desk Q2 sales beat estimates and the stock soars. Yes, it definitely did. Revenue was up 25.9% year on year. Guidance for the next quarter's revenue was also optimistic at $618 million at the midpoint, 2.1% above analyst estimates. So not only did they beat this quarter, but they also beat on the guidance expectation, which is exactly what you need in this type of market environment where Wall Street does not care about the quarter you most recently posted. All they care about is the guidance for the next 2 quarters. The 2 quarters next coming, guys, are going to be the ones where we closely watch these companies for any signs of recession indicators. So keep that in mind. Gross margin, 81.1%, in line with the same quarter last year. Free cash flow, $56.68 million, down 67.8%. This is because they had a couple capital expenditures to revamp some of their products and improve their offerings, but doing a very good job of utilizing the free cash flow that they have to do just that, guys, to expand the business, right? That's what they're looking to do. Very, very solid report by them. Founded by former Microsoft engineers Jeff Green and Dave Pickles, the Trade Desk offers cloud-based software that uses data to help advertisers better plan, place, and target their online ads. So the Trade Desk, guys, they do not run ads themselves. They are pretty much a middleman, right? They connect different, endpoint advertising locations to the brands that want to advertise on them, and they advise these brands as to what will be best for their products, right? So if you're Netflix, where should you advertise and how much money should you spend on each segment? Should you advertise on cable TV? Should you advertise on Facebook and TikTok? Or should you advertise on Google search? Which one is going to provide the best ROI for you? Trade Desk does all of that analysis and gives you the results to help you better position your advertising if you're a company like Netflix or others, right? So that's what Trade Desk does. Now, the digital advertising market is large, growing, and becoming more diverse, both in terms of audiences and media. As a result, there is a growing need for software that enables advertisers to use data to automate and optimize ad placements. Trade Desk is really one in the game right now, guys. There's really nobody else doing this at the scale that Trade Desk operates at. So you can argue that they have a very heavy competitive advantage, which is why a lot of folks love the company. Now, let's take a look at some of their numbers here, guys, in terms of their financial results. So we can see here the net income numbers posted. Very, very solid, guys. 14.5% net margins over the course of this quarter. Extremely solid if you ask me. And if you take a look at Trade Desk's net margin performance over the last foreseeable past, you can see they've been expanding gross margins now above 80%. Operating margins did have a very hefty dip here down in 2022 when a lot of companies were pulling advertising because of potential supply chain constraints and stuff like that and heightened levels of inflation, right? So Trade Desk slowed down, but nice to see they've now increased operating margins back to somewhat what they were prior to the pandemic. Still a ways to go, but nice to see they're moving in the right direction. And net income margins as well have now returned positive, just around that 9-10% mark. So for them to come in with another quarter here, guys, at 14.5%, that is better than all of the prior 5-6 quarters that they put in, really coming back to where they were used to being prior to the pandemic, right? Between that 14 to 16% net operating margin mark. Nice to see some decent recovery there. Now let's move on. So strong customer retention. Customer retention remained over 95% during the second quarter, as it has been for the past 10 consecutive years. So the people that use their product definitely like it enough to stay. Connected TV. The Trade Desk offers the largest connected TV inventory market in the industry. Now, even Netflix finally partnering with them. Netflix announced it will expand buying capabilities to include the Trade Desk as one of its main programmatic partners for advertisers. Very, very, very solid here, guys. Fox News as well did the same thing. CBC announced the partnership with them for the Olympics as well, and so many other nice things as well. So they just continue to onboard more and more partners, guys. Their partner list is extremely expensive, right? They literally say we buy the whole internet. So they have so many different partners here, guys. And the list doesn't really stop there. They actually have a more extensive list all the way up here, depending on the category that they're in. You can see just a few of the names that are in there. All of the biggest companies in the world are definitely working with the trade desk right now. So moving on down, guys, let's take a look at some of their further financial metrics just to show you guys what I was on before. Robust revenue growth, no problem there. Every single year, they continue expanding revenue very beautifully. Here you can see it on a quarter-over-quarter basis. Yes, there are a few slowdowns, as you can see, but for the most part, everything moving in the right direction with substantial profitability as well. So here's your adjusted EBITDA, always moving in the right direction over the past, let's say, 6-7 years. And even non-GAAP net income, guys, continuously rises almost every single year without failure. So very, very solid company, guys. Expanding profit margins back to what they were. The company's moving in the right direction. The only thing, and really the only thing that I have to say about this company, well, we can go over the share repurchases. They didn't purchase anything in terms of stock in the second quarter of 2024. They still have $575 million of buybacks outstanding. The one thing that I have to say about the trade desk, guys, my one little piece of red flag, well, not really a red flag, my one gripe with the company essentially, right, has to be the stock-based compensation. All right, so the stock-based compensation, you can see right here, $236 million. This is just too high, guys, way too high. It is 22% of their entire revenue for the last 6 months ended, guys. It is way, way, way too much in my humble opinion. They need to get this down to a more manageable level, like 10 to 15%. Now, yes, you can say that they do burn shares as well by buying back. You can see they did that in the 6 months of 2023. They issued 230 million shares, but they bought back more than that at about 336. But now, in terms of the last 6 months, they do have a net. They do not have a net burn, right? They actually have a net increase in shares outstanding. So curious to see whether they're going to use buybacks for the remainder of the year to really get this number down. But essentially what I'm saying, guys, if the number wouldn't be so high in the first place, well, you wouldn't need so many buybacks to reduce your share count. This is the only little piece here that I do not like about the company. In terms of free cash flow, another good quarter of free cash flow for them, about $237 million of free cash flow, which is really in line with what they've been having previously. Right? Actually, one of their better quarters in recent memory. Take a look here. Usually they bring in anywhere between $150 to $200 million in free cash flow per quarter. So this is one of their best quarters in recent memory. Take a look as well. Their balance sheet, very solid. No real debt to speak of, guys. Way more cash and cash equivalents on the balance sheet than debt. Not a problem for them. In terms of the business expansion over the foreseeable future, very healthy EPS expansion. Streamlined, consistent, and smooth. Revenue expansion as well. Consistent, streamlined, and smooth revenue expansion. Very good. So let's look into some of the valuations at $94, where they are in the after hours right now. Is the company a good buy? Well, they're growing revenue very nicely, 18% per year, and growing EPS by 28% as well. Now, that gives them a forward PE at $93 of about 60.4. A little bit high if you take this as an independent number. But when we divide this by their EPS growth rate, you can see they have a PEG ratio of about 2.15. Quick reminder, anything under 1 is very cheap, between 1 and 2 is okay, and above 2 is a little bit expensive, which is why I wrote down it is a little bit high, guys. Yes, it's a great company, solid business model, but the valuation right now is a tiny little bit high. I've said this once before on the channel, and I'll say it again. I really like Trade Desk, guys. If for ever it's reason we really do fall into some further drawdown in the stock market over the next 1 to 2 months, and I can maybe find Trade Desk trading back around where it just was this week. I really like this level down here, guys. $80 to about $70. The valuation becomes a lot more manageable for the company, and it is a more larger area of support for the stock as well. You can see that on a monthly basis, guys. Usually this level right there, 70 to 80 bucks, could be a great level for a potential retest if ever we fall back there for some eventual trend expansion later into 2025 and 2026, right? So those are my thoughts on the Trade Desk. Solid company, but just be a little bit careful with the valuation right now, especially in times of economic uncertainty, right? You really don't want to go extend yourself on stocks that are close to relative highs at high valuations, because those can be the first ones that are hit, even though their business model won't be fundamentally that affected by the slowdown. You guys know how it works, right? When the market goes down because of a recession narrative, usually it pulls down everything with it. So just be careful with this one. Moving on in, guys, that's pretty much everything we had with our earnings report. So hopefully you appreciated those. Now, moving on into our technical analysis. And the bulls had a save to do, guys, and they absolutely did it. Take a look here, guys. We were watching for the potential loss of the hourly time frame, right? We were saying that because we had a nice hourly bounce underway, and then when we lost the hourly, if the bears were to roll over the hourly time frame into an hourly downtrend, we would be at the end of our daily bounce and maybe due for further downside continuation. The bulls literally had pennies to save this, guys. Here is your Tuesday market open, right? They had pennies to save the lower low and maybe prevent an hourly downtrend formation in the regular hours of trading. And we got an engulfing move. Take a look at this low right here. The low was 517.88. This low right here, 518.05. Literally only 20 cents away from flushing those lows and setting up the bears for the hourly downtrend, which would have meant further daily downside continuation, right? Just continuation of this daily downtrend. Now the bounce simply continues. So daily bounce remains underway. And so we keep an eye, guys, on the continuation of the hourly trend. Need to keep this hourly trend alive, need to keep this bounce going. Why? Because the bounce size is still not yet sufficient enough to guarantee that the bulls have a chance at resetting into a daily uptrend in the event we start rolling over as early as tomorrow. The size of the bounce right now is only about 50%. Usually to have a very healthy bounce, you want to see a 618 or all the way up to about 80%. That would give the bulls enough space to then set up for a daily higher low and get a daily trend change back in motion and start reversing a lot of this weekly damage that's been done over the past 4 weeks. So the bounce size is still decent, but we need to pay special attention to it, guys. If for whatever which reason, tomorrow we're into Monday, we lose the hourly trend, you guys know that when the hourly downtrend is set, your bounce is finished, and then we look to the bulls to see, can they hold into daily higher lows and manifest a new daily uptrend. At least we are back above our large area of support, 524 all the way down to about 507. This huge green box, guys, extremely important weekly level, prior weekly resistance of the all-time highs, now acting as support for the markets. So we will see over the next few days of trading. Crucial, guys, if the bounce can continue a little bit more, it can set the bulls up nicely. Keep in mind, we have some resistance here. If we can get all the way up there, guys, and maybe reject from there, that would be a heck of a bounce. We'd be talking about at that point exactly, funny how that works, right? Exactly a 618 bounce at that resistance level. That's where I really want to see the bulls pull into to have a better chance at being able to reset a little bit lower and try for the daily trend change attempt. So we'll keep close eyes on this, guys. But as of now, the bulls are looking good, but they still have a lot of work to do. Moving on to QQQ. So moving on to QQQ as well, keep an eye on this bounce as well. So daily downtrend obviously in motion. We were looking for some continuation, but the bulls saved it in the regular hours of trading. Same concept, guys, not flushing the lows, protecting these lows with their lives. No hourly downtrend was set. The bulls came back roaring with an engulfing move. Now we need a resumption of the hourly trend, and your daily bounce will simply continue. Keep an eye on the size of the bounce on the QQQs, guys. So far as well, only about 50%. I would need to see them come in at least to the 618, which is exactly where the 12 EMA, this yellow line, is sitting right there, and exactly as well where your previous support, which is now resistance, is sitting too. So need to see the bulls pull into that area. Maybe then they get rejected. This could obviously be another location to maybe load up a bit of shorts, guys, right? So the retest and then maybe short, but then keep in mind, we're maybe looking for a daily higher low and manifest into a potential daily trend change if that bounce size is adequate. Obviously, if we roll over from here with only a 50% bounce, guys, it does favor the bears for at least a chance to retest the lows. So trade accordingly, guys. That is how I'm going to be playing all of these things. I will personally be waiting for this extension to the bounce, maybe to load up a few swing trade shorts into here, and then I'll be looking for the daily higher low. How do you know it's a higher low after? Well, you'll see something like this, right? Come up, loss of the hourly trend, then hourly downtrend. As soon as you see hourly trend reversal, that's when you know the daily higher lows are set, and then we're looking for some daily trend expansion. Hopefully that makes sense. Moving into XLF financials right now. So financials, not looking too bad, up 1.61% on the day. Very healthy day for them. But Financials need to get more of a bounce underway too, because right now, with such a heavy move to the downside, maybe just looking for a lower high, and then it's up to the bulls to prove to us, can we get the daily trend change back? Well, keep in mind, where are we rejecting from right now, guys? This previous all-time high line of resistance, it's plaguing us as well. The short-term moving averages are also above us. So keep an eye on the size of the bounce. So far, the bounce is almost 50%, which is exactly the level that they need to break above right now. We need to get at least a 618 to give the bulls the best odds at being able to reset the daily uptrend to the upside. As of now, 50% is decent, but it's not enough to guarantee the bulls a chance. If anything, if we roll over from here, it gives the bears another chance to retest these lows, right? So that's pretty much everything for your financials analysis. Just keep that in mind. The daily uptrends are key, guys. Only when we start reversing these into daily uptrends can we then talk about some potentially weekly momentum to the upside as well, right? I know the weeklies look like they're having a nice recovery right now, but there is no confirmed daily uptrend. We are still just looking for lower highs, and then it's up to the bulls to prove to us, can they translate that into daily uptrends? Hopefully that makes sense, but we're reacting nicely from this area of support right now. Moving on to healthcare. Healthcare having a very good day today, 2.21%, and that was largely off of the back of some Eli Lilly earnings, up almost 10% on the day. Such a solid company, Eli Lilly. Moving on into healthcare right now. So healthcare had the daily downtrend, and now they've engulfed the most recent move. So as soon as this move is topped out, guys, we're going to be looking for the bulls to set up for a daily higher low and get this daily trend change back. Now that they've actually pretty much canceled the daily downtrend, we can say that the weekly higher lows are set like this, right? Weekly higher lows are set and looking for continuation of the weekly uptrend. They have never lost the weekly uptrend. SPY has lost the weekly uptrend. These higher lows were flush, so loss of the weekly uptrend there. QQQs as well, loss of the weekly uptrend. Higher lows were breached, and XLF financials as well. Well, not quite, but dangerously close to losing the higher lows as well. Healthcare is really the only one that's had very robust price action so far. So looking for the bulls to possibly continue that into the next short form, into the next few weeks. Moving on to semiconductors right now. Give me a quick second. All right, moving on, guys. So SMH having a very healthy bounce, guys, 6.36%. But even a 6% day looks so tiny because of the magnitude of some of these candle drops, right? But still, very nice bounce for them. They also had a very big job to do here today, right? So you saw, obviously, with yesterday, the loss of the hourly trend, but the bears never set the hourly downtrend in motion. It allowed the bulls to completely engulf them. Now we're going to be looking, same thing as SPY, as QQQ, as the rest, right? Looking for the hourly trend recapture by the bulls to continue this daily bounce. Looking very, very decent in terms of the size of the bounce right now, guys. In terms of the size of the bounce, we are looking at pretty much a 50% retracement to the upside. Need to see a little bit higher, 618 around the 230 mark, which is pretty much your 12 EMA of resistance, and also this previous horizontal level of resistance too. So I'd like to see the bulls pull into that 230 area before possibly being rejected, because it would give them the best chance at setting maybe a higher low in motion and then setting a daily uptrend in motion as well. Keep an eye, this area above us, guys, this red box is going to be very solid resistance for the bulls, which is your prior all-time highs right back here that were previous resistance, and now they will be acting as a resistance zone as well. So maybe shaping up for a little bit of a rejection here, and then it's up to the bulls to prove to us, can they get the daily uptrend back and start reversing some of this weekly damage with the weekly bounce and trend change as well. All of that will be on deck, guys, over the next couple days of trading. So decent little tiny short opportunity right here, but in the event that the bulls just blast through it, well, then we will just be looking for the daily uptrend formation by the bulls, right? So looking not too bad on semiconductors, but they still have a lot of work to do. The bounce is step one. The daily trend change is step two. And then we need to look to the weekly for the same size of the bounce to guarantee that we're getting some higher time frames back. Now, moving on into IWM Russell. So the Russell having a decent day today, 2.43% to the upside. But look at the size of this bounce, guys, in the context of the size of this drop. Definitely not the best, right? Keep in mind as well, we have overhead resistance, 210 down to about 208. This yellow box right here is going to be prior resistance, right? Ever since the entire month of, or the entire year of 2024, will be acting as resistance once again. Keep an eye, guys, on the size of the bounce, right? The bounce right now, very, very weak, only about a 35% bounce, does not guarantee the bulls having a chance of setting for a new daily uptrend, right? You would need to at least see a much higher bounce for that to be warranted, at least 50% at best, all the way up to the 618, which is 216. So a lot of ground to cover for the bulls right now. If they roll this over as soon as tomorrow into next week, the probabilities do favor a bearish rollover of the lows, which may plunge us into some lower weekly levels as well, talking about maybe the 191, 190 for the next location of support right down there, because right now, all of the weekly momentum, guys, has pretty much been lost. So the best we can expect, maybe a tightening range, and the worst we can expect is obviously weekly lower high into weekly lower low and consolidate down here in the lower 190 levels. Moving on to the Dow Jones right now. So the Dow Jones not looking too bad either, 1.78% to the upside, trying their best to also get their daily bounce underway. But keep in mind, guys, we have a few levels of resistance above us. Number one, we have all of the moving averages right there. And then we do have the previous all-time highs from back here, which will be a steady point of resistance for those bulls. Keep an eye on the size of the bounce here, guys, right? You guys know the drill by now. As long as we can continue these hourly trends into the tomorrow session, the daily bounce will simply continue. As of now, relatively weak for the Dow Jones, only a 38.2 bounce, not enough to guarantee that the bulls have a chance of a daily trend change shift. So we'll keep a close eye on that. Myself personally, I would need at least to see a 50% bounce, at best a bounce to the 618, about 41,100, which would be the best case scenario for the bulls to be able to reset this daily uptrend and start undoing a little bit of this weekly move down that we've seen. At least the Dow Jones has not lost the weekly uptrend, similar to the SPY and QQQ. The bulls are still in control of the weeklies on this one. So we will pay special attention, guys, how the price action is working over the next couple of days of trading. And that's pretty much everything for your indexes, guys. The VIX continues its daily decline, but just pay special attention to either geopolitical headlines, right? War headlines out of the Middle East, and also things like economic data, right? Very, very important to keep those two things in mind. In my opinion, the VIX will only move off of those, nothing else, nothing more. So right now we can see a steady decline coming more back into normalization territory in the low 20s and possibly into the sub 20s, guys, if next week also we do not get more negative data. So nice little decline there on the VIX. Now, moving on down, definitely have to talk about crypto today, because look at this day on crypto. Fantastic recovery by crypto. Crypto has been plagued by the same thing as the rest of the markets because it's a risk on asset. 12.25% day on Bitcoin. Definitely a fantastic recovery, right? So even though the short-term price action is relatively ugly, the same rules apply. Take a look at the size of this bounce on the daily, guys. This is a decent bounce, a 618 bounce. So if in the event, as soon as we lose the hourly time frame, we're going to be looking for a daily higher low to maybe get this back into daily uptrending mode. At least we came back above the area of contention over the last relatively, call it roughly 4 or 5 months at this point, right? Which was the 57 down to roughly 55, 54 location. You needed to see the bulls protect this one, and they did. We came below it, cracked below it, took out a bunch of stop losses, liquidated a bunch of traders as well, and now we're back above it. So we're still going to be looking for maybe this weekly tightening range to play out, guys. It's going to be very tough for Bitcoin to rally in the midst of recession concerns. So the best we can hope for is really to protect these lower levels, which the bulls cannot afford to lose, because if they do lose them too much here, guys, it's going to start a nasty monthly downtrend, and we could be seeing some lower levels such as the mid 40,000s. But so far, the bulls are looking very, very strong. Need to see them hold it up right here. In terms of Ethereum a little bit weaker than Bitcoin as of late, but still decent. Daily downtrend was clear as day, of course, culminating in a crazy liquidation event on Ethereum. Heck of a drop in a 1 week time span, guys. In just 4 short days, 35% to the downside. But then again, it's crypto. People come to expect it, right? Now, with the bounce underway, the bounce size is looking adequate, but not as much as Bitcoin, right? Only up about 45% in terms of the size of the bounce. So definitely not looking the strongest. The bulls still have a lot of work to do. I would like to see them come up at least to the $2,900 range, which is roughly that area of prior support. It is now going to be acting as resistance, but at least if they come up there, guys, it'll be a 50% bounce, and maybe they can make a second attempt at it by resetting the daily uptrend and putting an end to the weekly downtrend crush that just happened over the last 2 weeks of trading. So Ethereum, not looking too bad. I am still a fair buyer of Ethereum right down here in the lower 2000s, which is pretty much the area that I've been waiting for throughout the entire year. I did not add any Ethereum myself. I added Bitcoin and I did add some Solana on the drop. I already have decent exposure to Ethereum, so I'm not really looking to get more. But in the event, guys, that we get another dip back into these lower $2,300, $2,400 locations, I will maybe be looking to add a tiny bit of Ethereum. Now, moving on down to our big tech names, shall we? So moving on to Apple. Apple up 1.66%. Definitely a great recovery by them over the last 4 days of trading. Now, keep in mind, we are still in the context of a daily downtrend, looking for a bounce. And on Apple, guys, the bounce is substantial, better than the rest of big tech. 618 bounce, pretty much right on the dot. So in the event we get rejected by this little area of overhead resistance, this red box, and the moving averages, you guys can understand the 618 bounce is complete. And thereafter, we'll be looking for a daily higher low to reset this into a daily uptrend. That is going to be the best case scenario for the bulls. In terms of the weekly, well, you guys know we have lost the weekly uptrend by flush of the lower lows right here. So if they can recapture this daily uptrend in the next week or so, we will be looking for how much of the weekly move can they then recapture in relation to the size of this drop right now. The size of the weekly recapture, decent at about that same 38.2% level, right? So not too bad of a recovery by Apple, but as I've said many times in the past, guys, I will only be interested in Apple if it falls down significantly below the $200 mark. Think 195 down to about 185. That's where I want to play Apple myself. I cannot really play it up here. 3.08 PEG ratio, extremely high valuation for a company that where their revenue is slowing, and there's a little bit of uncertainty around competition in China for them as well. So definitely not the best. Definitely not the best landscape for Apple right now, but keep in mind they do have that new AI suite of products coming out this September. So maybe that sparks a massive upgrade cycle for them over the next 2 years, and maybe we can finally get back to higher revenue growth. But as it stands right now, at this price, at these valuations, it is a pass for me. For me to get interested, once again, 195 down to 185, I'll start playing Apple once again. Now, moving on to AMD. AMD having a very nice day of recovery, guys, and AMD is trying for something right here. What are they trying for here, guys? It is very notable right now, right? They're trying for the daily uptrend shift. That would be a break of Monday's high, 139.01. Give me a break of the 139.01. Daily uptrend is underway, and then our weekly lows are set. We'll be looking for the size of the weekly recovery. As of now, obviously the bounce isn't really underway yet, but I'd like to see a weekly recovery at least to the 155 level. Get me up to 155 and we can talk about the ability to recapture this weekly uptrend, because so far all of the higher timeframes on AMD are lost. Monthly uptrend, unfortunately, is now down, lost. Weekly uptrend, clear as day, right? Has been lost. So all the higher timeframes are lost and the daily is lost as well. Now we have to start everything over from scratch. Step number 1 is get the daily uptrend going into the 155 location. Step number 2 is get the weekly uptrend going again. And then obviously a longer step, step number 3 is going to be getting that monthly uptrend going again. But still, I love AMD in these lower locations right here. I've been playing it a bit between the 140 to 130 area, but where I would play it extremely heavily is if semiconductors for some reason have further declines. I would be very, very tempted to add quite heavily on AMD in the 120 down to about 105 location. This little green box down there, it represents some extremely good value for the company. Even right here at 145, the PEG ratio is only 1.18. Really, really cheap as a whole here, guys. So you can't go wrong playing AMD in these locations right now, but we know semiconductors are a little bit out of favor right now, and we do have an overwhelming recession narrative that's plaguing us. So if that drags AMD down even further, this is where I really want to go a little bit heavier. For now, playing it a little bit with some swing shares and some short puts, but down here I would consider going a lot heavier and maybe even with some leap calls, because 2025 should be pretty much their best year of data center expansion. Moving on to Amazon right now. So Amazon also not looking too bad, up about 1.86% on the day, but Amazon has a lot of work to do here, guys. A ton of work to do right now, but still the daily bounce is relatively well underway. Take a look at the size of the bounce, right? Size of the bounce, only 38%. So on Amazon, we would need to see at least a bounce to up to 50% or at best 618 to really give us the best chance at resetting this into a nice daily uptrend for Amazon. So far, so good. The bulls are putting in good progress. Just keep an eye, guys, on this hourly uptrend, right? Amazon has not been as strong as some other tech names that have been recovering, such as Meta and NVIDIA and AMD, of course, but still Amazon just moving along forward. I see no problems having some positioning on the stock down here. I love Amazon down here, as a matter of fact, guys. Lower mid 160s is a definitely add for me for a long-term portfolio or even an attempt at a little bit of a swing trade. But the deeper locations down here, guys, 150 to 140, if ever we come down there because of the economic uncertainty, recession narrative, stuff like that, right? It can happen. If ever we come down there, it would be a screaming buy opportunity. Already now on Amazon, guys, we are down 17% from the all-time highs. All the way to 150 would be 25 to about 30% to 140. That is a heck of a discount on Amazon. I like this location. Why? Because this entire location that we're operating in right now, guys, is huge prior support for Amazon all the way from 2020 to 2021, and their fundamentals are arguably much better than they were back here, even in the height of the online shipping frenzy during the pandemic. So very, very strong company. I like it down here, but we need to be a little bit patient with Amazon as well, right? So in the event that we're looking for the daily higher low, that is where I might be looking for a swing trade. Stops go below the lows, and you're looking for the daily trend expansion. If ever we can't get that done and we roll over lower, just understand, guys, I will be going very heavy on Amazon down here in terms of long-term portfolio ads and maybe even some leap call options as well. So that is how I'm going to be playing Amazon. But right here, can we nibble a little bit on Amazon? Absolutely. No problems with the company whatsoever. Moving on to Google. Give me another quick second. Google up a nice 1.92% today. Very nice day of trading for them, but still in the context of a daily downtrend on the stock right now. So we are looking for a lower high. Just the location of that lower high is what's more essential. Keep an eye on the size of the bounce here, guys. You will see the bounce barely not about 50%, right? So not the best bounce on Google. It doesn't guarantee that the bulls have a great chance at resetting the daily uptrend. But if we come a little bit higher, guys, don't need too much more on Google, right? Come a little bit higher, up to about 168, which is pretty much your previous level of a bit of resistance right there. Sorry, you can't see it. The fib is over a little bit. It's these two candles right here, right? If we can come up into the 167, 168, that will give the bulls a much better chance, in my opinion, at being able to reset this into a daily uptrend and start taking back a little bit of the weekly destruction that's happened on Google as of late, right? Just keep in mind, if we do get that extended bounce on Google, above us is a decent level of resistance, 171 to 179. And below us, if for whatever it's reason, guys, the markets continue their plunge and we get further sell-off, just understand right now, decent size, decent area to nibble on Google. But if we come down even more here, guys, 153 down to 144, extremely great buying opportunity for Google. Right now, they're down 14%. If they come all the way down there, they'll be 20 to 25% off from recent highs on Google. Go back in time for every one of these big tech names, guys, you know, maybe except for Tesla, right? And NVIDIA possibly. Go back in time and AMD, really the magnificent five. So Apple, Amazon, Google, Meta, Microsoft, right? The more stable ones. Any time in the history where you find 20% declines on these stocks, it's usually been an extremely good opportunity to be buying them, which is why I've been aggressively saying on the channel to start dollar cost averaging as we start dropping into this final area where I do think we find a local bottom for the stock, right? Just looking for a monthly higher low for possible further trend continuation. So Google not looking too bad, but the bulls still do have a lot of work cut out for them. So we'll take this one day at a time. Meta performing extremely well, guys. 4% to the upside, 4.25 as a matter of fact. Very messy price action, but you can kind of derive what the bulls are trying to do. We're trying to get back into a daily uptrend. We're trying to attack the all-time high area of resistance, which is 515 up to about 531. Meta putting in a better recovery than most of your big tech names out there, right? Meta is now only down from their all-time highs 6%. The rest of big tech is down significantly more than that from their respective all-time highs. Because I keep stressing this, guys, even though Meta is at the all-time highs, it's all in the fundamentals. The PEG ratio at 500 is only a 1.23. Meta stock is extremely cheap up here, guys. Even if the share price is at all-time high, the valuation is absolutely amazing. Whether you use the PEG ratio or the free cash flow yield, both are extremely good. Bulls looking very strong. As soon as this move is topped out, if we encounter some resistance above us, of course, well, we're just going to be looking for a daily higher low to resume the daily uptrend. The weekly as well is looking quite good. They really put a stop to the damage right here. They're trying to put in an engulfing move to regain that weekly uptrend, right? We obviously lost the weekly uptrend here by flushing these higher lows. So now we're trying to put in a two-step process of gaining that back. Same thing that happened right here, right? Loss of the weekly uptrend, and then it took them a two-step process to get it back. We're probably looking at the same type of context for Meta. So we'll take this one day at a time. One thing's for sure, I do maintain this. 480 down to 460, nice little nibble area for some Meta shares. And if for ever which reason, guys, we tumble even lower, think 430 down to about 400, this is where I consider going very heavy on Meta shares and even with some leap call options. Moving on to Microsoft right now. Microsoft with a decent day as well, 1.07% to the upside, but Microsoft, as well as the rest of most of big tech, still trapped in a daily downtrend. Now, we are having a decent bounce attempt by Microsoft right now. Keep in mind the size of the bounce. Size of the bounce is almost, with the high of yesterday, almost the 618. So now the bulls do have a very decent shot, guys, at getting a nice daily uptrend going. And where are we possibly using as support? This green box right here, 403 down to about 389. This is pretty much your support level from the entire year since January. So the bulls really need to hold this one. As a whole, if we can get that daily uptrend going, we will be looking to reverse a lot of this weekly damage too, because the bulls obviously lost the weekly uptrend by flushing these higher lows right there. So maybe similar to Meta, right? We're expecting maybe a two-step recovery process for the weekly uptrend by Microsoft, but we will take this one day at a time, guys. This level right here, 400 down to about 390. This is a great location to be adding some Microsoft shares, either for a little bit of a swing trade, right? Or even a long-term portfolio buy. Where I buy the dip extremely heavily is if ever Microsoft sells down even further because of economic downturn, recession narratives. You guys know the drill, right? 360 down to 340, that would be crazy. I would definitely be buying some leap call options down here and adding some shares heavily to my long-term portfolio. That would be a decline of 22 to 26%. I challenge you guys, go back in the context of overall bull markets. When you find Microsoft on dips of anywhere between 15 to 20%, it's usually been a fantastic opportunity to be buying some shares. Now, moving into Netflix. Netflix having a nice green day as well, 3.09% to the upside, and Netflix also with one of the better bounces in the industry right now. So looking quite good in terms of Netflix bounce size. Keep in mind, we were always in the context of a daily downtrend, and now we have a very juicy bounce. Take a look at this bounce size, guys. This is a bounce, almost 80% bounce. So now the bulls do have a very good chance at being able, as soon as this move is topped out, to either reset into a daily higher low and daily uptrend, or even engulf the entire move down and reset higher above this big support box. That would be a key level for them. That's pretty much 633 down to about 605. So Netflix with some very solid price action. Curious to see whether or not the bulls can pull off the daily trend change and put an end to a lot of this 5 weeks worth of consolidation. Maybe similar to Meta and Microsoft, need to probably two-step this weekly recovery as well. So need to see them get above this area right here, 635, to really get that trend change attempt underway. But looking pretty good on Netflix, not gonna lie. Moving into NVIDIA right now. NVIDIA also with a decent day of recovery, 6.13%, but NVIDIA, even a 6% day does not look like much because of the size of the moves recently, right? So NVIDIA, pretty much same thing. We were looking for the daily higher low for possible trend change. And contrary to a lot of other names, guys, NVIDIA, as a matter of fact, did put in the lower low, right? So they did actually lose the hourly uptrend. Excuse me, got some sirens in the background. Did lose the hourly uptrend, and now the bulls are trying to get it back. So NVIDIA is setting up now for a daily higher low attempt. If they break yesterday's high, 108.50, you will have an official daily uptrend moving on NVIDIA. And then we take a look, guys, at the size of the weekly bounce, right? Because we know we're in a weekly downtrend on NVIDIA right now. So we will keep an eye on the size of a weekly bounce. And same analysis applies, guys. Need to measure the size of the weekly to gauge whether or not we can get this weekly trend back. So that's going to be step number 2 for the bulls. Step number 1 is getting this daily trend change underway. And then maybe we get rejected at overhead resistance 115 to 120. One thing's for sure, guys, I still love playing NVIDIA down in these lower locations here. So I will be continuously writing short puts in the $95 to roughly $85 location. My preferred range for NVIDIA, playing some short puts, that would put them down 35 all the way down to about 40% from the all-time highs, which is why I really like playing them down there. Weekly RSIs are now a lot more manageable, even on the monthly guys, coming into more manageable levels too, hunting for that monthly higher low. And the dailies, of course, well, we don't need to talk about it. The dailies are definitely nowhere close to being overbought. So nice to see NVIDIA start to rally. This is your tech lead bull here, guys, right? So if NVIDIA sees more potential expansion, you may see some other bullishness in the rest of tech. So keep that in mind. Looking fairly good for now, however. Now, moving on to Tesla. So Tesla and on for NVIDIA as well, guys. Just keep in mind for all these stocks, right? The bounce size is essential, right? If we continue this daily uptrend, that is perfect. But if ever we roll over into tomorrow and whatnot, you guys know what to expect. Continuation of the daily downtrend and continuation of weekly consolidation. That goes without saying. So moving into Tesla right now, Tesla up a healthy 3.69%, but really nothing in the context of the last 4 days. Really no change, a lot of inside candles. So Tesla still in a daily downtrend right now. The bulls are trying their best to make an attempt at changing this into a daily uptrend. We will see if they can get that done by a break of 203. If they can get that done, daily uptrend is underway, and you have a little bit of weekly recovery, but the momentum is entirely lost for Tesla right now. The best chance that the bulls have, in my opinion, is probably for a tightening range more than anything, guys. Not that many positive catalysts on the way for Tesla, other than their robo-taxi day, which is in pretty much the month of October. So for about a month and a half, we have no news whatsoever for Tesla. So maybe the best they can get is a little bit of a tightening range, as they are in a sector that's out of favor, especially in terms of being in the spotlight of recession narratives right now. So keep that in mind for Tesla. I still do maintain, if I can get a little bit of a dip here, guys, right? If for some which reason we continue selling down on Tesla, down into this lower 180 range, I will maybe be playing some short puts, maybe 160, 150. Going to be very conservative on Tesla, guys, because it's in a sector that's out of favor right now, especially with that recession narrative, right? So bulls looking decent, but I'm not convinced. I need to see a little bit more discounts for me to get involved. And now lastly, a big one, guys, Palantir. Palantir with an 11.25% gain. Why? Well, here you go. Palantir stock climbs on AI partnership with Microsoft. They jumped after the company said it partnered with Microsoft to sell AI-based data analytics products to U.S. government agencies. Extremely good partnership for Palantir, right? With one of the best companies in the entire game right now. Through this partnership, Palantir plans to deploy a suite of products in Microsoft's government cloud's environments. Palantir said it would be an early adopter of Azure's OpenAI service in Microsoft's secret and top secret environments. Ooh, so Palantir getting some access to some, behind the scenes Microsoft activity. Very good day for them, guys. And they really need a day like this to try and break through an area that's been plaguing us for quite some time. This infamous $28 to $29 big resistance level from 2021 and 2020 now coming into play again. Look at this weekly move by Palantir. Crazy off the bottom, off of Monday's lows, now up 35%, guys. Extremely solid bulls in Palantir right now. So daily obviously was a daily downtrend leading into earnings, and now we have the fully engulfing move looking excessively good. That is one single daily move here, guys. So the best case scenario for the bulls is we need at this point, give me the breakout. Give me the breakout of such a hotly contested area, and then we'll be looking for the following trade. Breakout, retest of this range. That is your trade for the runner. If we get the retest, very simply, the stop loss goes below $28. So we're looking for lower 29s as an entry, and then we're looking for stop losses below here, and then we're looking for the trend expansion all the way to our next target, which has to be this gap fill here, 32, and then all the way up to about 35. Looking very solid on Palantir. That could be a very juicy trade, which I am looking to play. Now, there's always the flip side scenario where we possibly get rejected from here if tomorrow's trading is weak and plunge a little bit lower. At that point, we'll just be looking for a daily higher low to make a second stab at it. If ever we get that higher low, the next area of support below us, guys, 26.25. With such a high move right now, guys, even on a little bit of a pullback from here, I could be tempted to make some short puts. $26 to $25 range seems like a great area for Palantir right now. Palantir bulls in control of most timeframes. Weekly, still a very decent time frame for them, and the monthly as well. Gorgeous monthly uptrend, no problems there whatsoever. So Palantir really doing a great job here, guys. probably one of my favorite software companies in the game right now. This is a long-term hold for me. I have a ton of shares in the lower $11 range. I haven't really been adding much to the company, but I do still love playing it in these locations down here off of any retest scenarios, whether that's a retest from here, down here, and break, or breakout and retest this. Both trades are viable options in my opinion. That's pretty much everything I had for you guys in terms of today's video. We will do a portfolio recap tomorrow with all the trades I made yesterday, today, and some that we're going to close tomorrow, guys. Though, you know, most of them were really just some earnings plays that I was playing pretty much throughout. Played some Elf Beauty, played some Trade Desk. Yesterday, we did play some Shopify, some Robinhood as well, stuff like that. So it's been a fairly good week for us in terms of swing trading as well. Pretty much good week as well for the wheel strategy. We'll do a full recap in tomorrow's video because tomorrow we probably won't be covering any earnings. So we have a lot more time to discuss trading, trading opportunities, and my own portfolio. So that's pretty much everything for today's video, guys. Hopefully you appreciated that. If you did, consider dropping a like. Would appreciate it for the growth of the algorithm. Also consider subscribing to the channel if you're new. Would love to have you back here. And lastly, if you have any questions at all, whether it's macro discussions about the recession, technical analysis on a stock, an options play, anything you want, guys, leave it down below in the comments and I'll be very happy to answer you. So take care, guys. Looking forward to discussing a lot about trading, opportunities, setups and styles. That will be the gist of tomorrow's video. We're going to spend a lot of time on that tomorrow, right? So take care, guys. See you tomorrow after the close, and peace.